Hi students, today in this video we will be discussing about chapter 6, which is Companies Act. So in this chapter there are 13 aspects which we are going to discuss. It starts with introduction, why Companies Act was introduced, Companies Act 2013 got introduced, applicability, to whom this act is applicable, definition of company as per few professionals, also as per the act. Then we also see the features of a company or characteristics of a company. Thereafter, we will see corporate wheel. We'll understand what is corporate wheel and when, in which scenarios corporate wheel will be lifted. Classification of companies, how many types of companies, private limited, public limited, unlisted, listed, 1% company. What are the classification of companies? Incorporation, how a company can be incorporated. Classification of capital, thereafter shares. Memorandum of association, which is Constitution of Companies Act, Charter of Companies Act. So like natural persons are governed by Constitution of India. Similarly, the company, artificial person, is governed by Companies Act and its own MOA, Memorandum of Association. We'll learn about that as well. Then we will move to Doctrine of Ultra-Virus, Articles of Association, then Doctrine of Indoor Management. So these are the 13 aspects we'll cover in Companies Act. So let us start with introduction. So why Companies Act 2013 was introduced? First, we should ask why Companies Act 2013 is needed. Are there any act before Companies Act 2013? The answer is very much yes. There is Companies Act 1956. So there were certain drawbacks or there were certain improvements to be made to Companies Act 1956. Hence, Companies Act 2013 was brought. So what are the changes? Due to changes in national and international economic environment. So there are fast growing economies now. The act which was there previously, if you need any changes, you need to put that bill in parliament. So in this act, most of the sections you see prescribed. The word prescribed is used in most of the sections. So what do you mean by prescribed? So they can come up with rules. So from 1956 till 2013, there were not so many amendments which they could able to get because the power of changing the Companies Act with Parliament, not with Ministry of Corporate Affairs. It is with Parliament. Hence, they does not have power to change the act. They does not want to update the act as per the changes in the economy. So now in this new act, most of the sections are given with the word prescribed. So now the Ministry of Corporate Affairs, respective ministry, has power to give rules. We will see such prescribed in coming slides. So due to changes in national and international economic environment. So what are the changes? So now 1956, if you can see till 2000, 2010, the economy was not that robust. But every year now, it's fast moving culture. There is a globalization. There is privatization. So the economic, the national and international relations, geopolitics relations have improved. Next, there are a lot of scams. There are a lot of scandals which occurred during this period. So this forced government to come up with certain rules and stringent rules that has to be implemented in the act itself. So these are the national and international economic environment changes which has happened, due to which Companies Act 2013 was introduced to replace Companies Act 1956. Not only this, to facilitate expansion and growth of our economy. Not only what has happened in the past or what has happened in the present, keeping future into consideration, they have made this act. And also to consolidate and amend the law relating to companies. There were banking companies, there were insurance companies, there were electricity companies. Each company has their own set of acts and their own set of rules and regulations. So to consolidate all the companies and relevant acts, this Companies Act was brought. So these are the three things why Companies Act 2013 was introduced. Composition. It contains of 29 chapters, 470 sections, and 7 schedules. Let us see. It contains how many chapters? 29 chapters, 470 sections, and 7 schedules. So it's a big chunk to cover, right? That is the reason this law was there in all three levels of CA. It is in CA Foundation, it is in CA Intermediate, and it is also in CA Final. So we will be covering almost 80 to 90% of the syllabus in three levels. So in first level, which is CA Foundation, we are going to cover 13 aspects, which we have just discussed, from introduction till doctrine of indoor management, right? So this is what Companies Act 2013 comprises of, its composition. Then we also understand the objective, the purpose of Companies Act. So the purpose is to improve corporate governance, simplify regulations, strengthen the interest of minority investors. So to improve corporate governance is a big subject. It's a vast subject, right? So corporate governance, what is corporate governance? Remember three words, sorry. FAT, fairness, accountability, transparency. So the company, they deal with employees, they deal with investors, they deal with suppliers, they deal with customers, they deal with government, they deal with bankers. So we collectively we call them as stakeholders. So company like Infosys, like Tata, like Reliance, they are not only working for themselves or their owners, but also they are working for public. Public has invested into Reliance shares. Public has invested in Tata shares. Public has invested in Infosys shares. Banks have given loan to Infosys. Bank has given loan to uh, Reliance. So banks have interest. Government collect taxes from these companies. So government has interest. So all these interested parties collectively we call them as stakeholders. Now, how company has to deal with these stakeholders? They should deal with these stakeholders fairly. They should deal with these stakeholders transparently. They should deal with stakeholders with accountability, with utmost accountability. So these collectively, fairness, accountability, and transparency between whom? Between company and their stakeholders. We call it as corporate governance. Let us take an example. Company took a loan from bank. So they should report their inventory position to bank on monthly basis. Accurate information about their inventory to bankers. Let us say they have 10 crores worth of inventory, but they showed to bank 12 crores of inventory. Is it fair? It is not fair. So the company, when they are dealing with banker, they should be fair enough. They should be transparent enough. Let us say some fire accident occurred. Let us say the employee union has had a trouble. So this information has to be mentioned in their annual report. This information has to be brought to the notice of public. Accordingly, public will take decision. So something happened inside the company has to be, which has to be brought to the notice of stakeholders, has to be informed. Otherwise, they are not transparent enough. So if a company is not transparent enough, they are not following corporate governance. So the relation between company and their stakeholders with respect to all the transactions, how they are doing, whether they are doing fairly, whether they are accountable for that, whether they are transparent or not, we call this cumulatively called as corporate governance. And also simplify few regulations, strengthen the interests of minority investors. Who are minority investors? Like Reliance, if you take, who is the majority investor? The Ambanis are the majority investors. The general public are minority investors. So the general public are the minority investors. So keeping public interest in view, they have made this act, and this is the objective of Companies Act. And not also that, they also introduced the role of whistleblowers and provisions relating to class action suit for the first time. So this class action suit, there are CEOs, there are MDs who are running the company, who are making strategic decisions. CEO, CFO, key managerial personnel. These people are the ones who are taking the decisions. So they should take decisions which is in fair in nature. Let us say they are not taking the fair decisions. They have some vested interest. They participated in some insider trading. Then the general public will be provided with this class action suit. The auditors. So all these people, the general public can file a case, can sue the auditor, can sue the CFO, can sue the CEO, MD, directors for any wrongdoings. For the mistakes they have done, they will be punished. So that is the first time they brought into this act. Role of whistleblowers. If someone wants to explain explain wrongdoings of companies, fraud happening in the within the company to general public, they can do it through whistleblowing. So such people we call it as whistleblowers. So that concept was also very much provided in Companies Act 2013. Hope we are clear. So introduction, why do we need Companies Act 2013? The changes in national and international economic environment, fast growing economy. For every change, they cannot go to parliament. They should have a power. The ministry should have a power to change the rules. There are scams and scandals happening. So we should take stringent rules. Stringent action has to be taken. Expansion and growth of economy, not only past and present, keeping future also into consideration, and to consolidate amend the multiple laws which are prevailing in the country. This is why Companies Act 2013 is brought. Composition, 29 chapters, 470 sections, and 7 schedules. We will be covering in all three levels of CA. Then objective or aim of introducing Companies Act 2013 is to improve the corporate governance. We remember FAT, fairness, accountability, transparency between company and its stakeholders. They should be transparent, they should be fair enough, and they should be accountable for the actions what they have done. One more example I'll tell you. Ratan Tata or Tata companies, Tata Motors, when they have issued Nano. So there is some trouble with regards to electricity in the Nano car. So they call back the cars. That is accountability. Even in Nestle Maggie case, they call back entire the batch production of Maggie. That is taking accountability of product failure or product damage. So companies should take accountability of their mistakes. So that is accountability. Okay. So that is what it is. Next, we have talked about first time introducing of class action suits and also describing the role of whistleblowers. This is part of introduction. Next, we'll see applicability. For whom all applicable, this Companies Act 2013 is applicable. So companies incorporated under this act or under any other previous law. 2015, 2017, someone wants to incorporate a new company. There are multiple startups coming up. They want to incorporate a company. To them, this act is applicable, very much applicable. Companies incorporated under this act, or under any other previous company law. There are companies which got incorporated in 1950, 1970, 1990, 2000, 2005. So Companies Act 2013 is applicable to them as well? Yes. Companies incorporated under this act or under any previous company law. Insurance companies. Previously, there was Insurance Act or IRDA Act, which was governing insurance companies. From Companies Act 2013 getting introduced, even Companies Act is applicable to insurance companies. But here is a catch. So the provisions which are mentioned in this Insurance Act or IRDA Act and the provisions mentioned in Companies Act, let us say there is some inconsistency. Now, which will prevail? The specific over general. So what is the specific act for insurance companies? Insurance Act or IRDA. What is the general act? Companies Act. So the specific act will prevail over general act. The Insurance Act will prevail over Companies Act. Similarly, it is applicable for banking companies. It is applicable for electricity companies. And the case again, the same thing will apply, specific over general. Let us take an example of banking companies. In Companies Act, they have clearly mentioned about how to compute managerial remuneration. What is the maximum limit for managerial remuneration? What is managerial remuneration? The remuneration, the compensation, the salary paid to directors. The salary paid to directors, both dependent, independent, executive, non-executive directors. This we call it as managerial remuneration. So Companies Act 2013 clearly gives how we need to compute managerial remuneration. What are the components to be considered? What are the components to be excluded from managerial remuneration? And what is the maximum permissible limit for managerial remuneration? In case of losses, how managerial remuneration is computed and to whom managerial remuneration can be provided. These provisions are not available in Banking Regulation Act. Hence, Companies Act prevails. Whereas Banking Regulation Act tells if you compute managerial remuneration, it has to be taken prior permission from RBI before you disburse the money. So these are the provisions mentioned in Banking Regulation Act. The procedure of approval, whom approval, when we should pay, all these things were mentioned in Banking Regulation Act. Whereas Companies Act mentioned how you compute, what is the maximum slab, maximum permissible limit. In case of losses, how we need to pay maximum managerial remuneration. All these aspects are discussed in Companies Act. So from now on, from Companies Act 2013, banking companies also has to adhere to Companies Act 2013. So there are rules not mentioned in Banking Act, but Companies Act, we should follow Companies Act. There are rules which are mentioned in both and pretty much same, then there is no problem. There are rules not mentioned in Companies Act, but mentioned in banking has to follow. There are rules mentioned in both, but there is inconsistency between both, which will prevail specific over general. So companies incorporated under this act or previous law, insurance companies, banking companies, companies engaged in generation or supply of electricity. So here thermal generation, which is coal based, hydel generation, which is water based. Then you have wind generation companies. So we are talking about generation or supply of electricity, right? Next, any other company governed by special act. Talk about ICAI. ICAI is formed from ICAI Act 1949. There is Institute of Cost Accountants. There is Institute of Company Secretaries. So any other company governed by any special act for the time being in force, also Companies Act is applicable. Thereafter, such body corporate notified by central government. Any body corporate notified by central government, if they notify, then this act is going to apply. So for which all companies it is applicable? It is applicable to companies incorporated in future, in present, and previous. Insurance, banking, electricity, special act, and body corporates governed by body corporates notified by central government. We are clear with applicability. We will discuss definition. Definitions of company from professional point of view and from act point of view. So professionals, the Professor Haney has described company as an incorporated association, artificial person created by law having a separate entity with a perpetual succession and a common seal. What is separate entity? What is perpetual succession? What is common seal? What is incorporated association, artificial person? All these are also covered in features. When we are describing features, we'll discuss in detail. So a company is an incorporated association created by law. So we need to submit few documents to ROC, to Ministry of Corporate Affairs, with which a company will get incorporated. A company's birth will happen. So that we call it as incorporated association. Who created company? Who created this artificial person? Created by law. It is not less than a natural person. It can own properties. It can sue someone. It can be sued by some other person. So it has all the powers of a human being or a natural person. So it's an artificial person Who created this artificial person? This artificial person is created by law. Then separate entity. It is separate from its owners. It is separate from its owners with a perpetual succession. So as it is created by law, this artificial person can be destroyed or winded up by law itself, not by any other person. And a common seal. As natural persons has signature, companies have common seal. This is how Professor Hani has described the company definition. Here, describing company, the features are also covered. We will deep dive into features in some time. Chief Justice Marshall, he described company as an artificial person again, invisible, intangible, existing only in contemplation of law. So can you touch the company? No, it is intangible. It is invisible. So it is created only in the eyes of law, mere creation of law. So it possesses properties which the charter of its creation confers upon it. What is charter? Charter is nothing but the constitution. So MOA, Memorandum of Association, Companies Act 2013, collectively known as charter, collectively known as constitution for an artificial person, which is company. So a company cannot do any business. So a company has to do the business which is mentioned in their objects clause in MOA. So let us say the objects clause was mentioned as manufacturing of tiles. Can they procure liquor? Can they procure yarn? No. They should procure the raw materials for manufacturing of tiles, marketing of tiles. They should procure services for distributing of tiles. So the charter, as natural persons, constitution is applicable. Artificial persons, for company, Companies Act and MOA is the charter, is the constitution. Next, as per Act, the definition of as per Act is quite simple. It defines company as a company incorporated under this Act or under any previous law. A company which got incorporated under this Act or any previous law, which is mentioned in Section 2, Clause 20. This is the definition of company as per professionals, also as per the Act. Next, we come to features. So features or characteristics of a company. There are 5 features of company, which is separate legal entity. An entity is separate from their owners, separate legal entity. It has its own existence. Perpetual succession. The company as created by law, it will be destroyed or it will be winded up. It will be closed by law itself, not by any other person. Mere death of owners, mere death of directors cannot harm the existence of company. That is the reason we say company has perpetual succession. Next, company is considered as artificial judicial person. Then you have the liability. The members of the company has limited liability. What is it? We'll discuss. Then we have common seal, the signature of the company. As humans, natural persons has signature, artificial person has common seal. We'll discuss. Before discussing these 5, how do you remember these features? So collapse, if you read it reverse, common seal, limited liability, artificial use person, perpetual succession, separate legal entity. The acronym or the mnemonic for remembering features or characteristics is collapse. Hope it is clear. So let us discuss separate legal entity. Separate legal entity. So when a company is registered, it is classed with a legal personality. The moment it is registered, the day it is registered, the company is born. So the day it is born, it has its own existence. So it is clothed with legal personality. We call that as corporate wheel. We call that as corporate wheel. Its existence is distinct and separate from that of its members. So owners are different, organization or the company is different. So company can own property, have bank account, can take loans, can incur liabilities and enter into a contracts similar to a natural person. So it has almost same rights and powers as human being. Even members can contract with company, acquire right against it, or incur liability to it. For the debts of the company, only its creditors can sue it and not its members. So can members contract with company? Very much, yes. So customers can contract with companies, suppliers can contract with company, employees will contract with company, government will contract with company. All these stakeholders will contract with company. They can acquire right against it or incur liability for it. For the debts of the company, only creditors can sue, but not members. What is this? We'll discuss when we are discussing classification of capital, equity share capital. So although capital is contributed by shareholders, company becomes the owner of its investment and assets. So who incorporated the company? The promoters, the owners have incorporated the company. Now let us say they invested 10 lakhs in one company. With that money, company has acquired some land, acquired some furniture, acquired some laptops, etc. So this furniture, this laptops and this land belongs to company, not belongs to owners. The property which was owned by company, it is property of company, but not property of owners or equity shareholders. That is what this sentence is all meant about. The capital is contributed by shareholders. That doesn't mean they will become the owner of investment and assets. The company purchased land, the company purchased laptops, the company purchased furniture. Who is the owner of these properties? The company is the owner, not the shareholders, not the contributors of capital. Why? Because there are separate legal entity. Company is different, owners are different. Next, the shareholders are not the private or joint owners of the company's property. They cannot, they are not the owners, they are not the joint owners of company's property.